Hello and welcome everyone to this latest weekly market recap. This is for the week ended September 6th, 2024. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with you all this weekend. Uh, Really difficult week last week. First of all, we had some of the biggest weekly declines of 2024. Some areas may have seen their biggest of 2024, including both technology and the NASDAQ 100 or the NDX. NDX down almost 6% for the week. The XLK, which tracks the technology group, down about 7.5% for the week, maybe a little bit more than that. So clearly, really difficult week for equities. We had the jobs report, a couple jobs reports out last week. Not only did they come in below expectations, but positive. They both came in positive, the ADP employment report and the non-farm payrolls, but they did come in below estimates. And the non-farm payrolls, which came in below estimates for the month of August. We also saw both June and July jobs numbers revised lower. So not a great look to the economy. I think that was a big part of what was going on with the market last week. We've talked about the fact that interest rates stayed high for so long because of inflationary pressures. The Fed is now saying, okay, we're not worried about the inflationary pressures anymore. At least that seems to be what they're saying, because they are now saying that it's time to change their policy, which means moving from hawkish policy to more dovish policy. And that would indicate to me that their job on inflation is done, or at least they believe that it's done at this point. And they've been very slow to accept the fact that their job is done. So the fact that they finally said it, I really don't believe they're going to go back on that word of theirs. We'll see. But I would expect certainly rate cuts coming in September. So with some of the other areas like technology, the key areas like technology being hit, I think it begs the question, are we going to have a recession? I don't know the answer to that one. I think that clearly the economy has slowed. Whether or not it slows enough to send us into a recession remains to be seen. I do think that by the time the first quarter and certainly the second quarter of 2025 roll around, I believe these rate cuts that are going to start happening will have a much more positive impact on the economy. So if we're going to have some sort of a problem with the economy, I believe it's much more likely to happen here over the next 3 to 6 months than it is beyond that. That's just my opinion, and we'll see how things play out. But my guess is that if we do have a recession, it's going to be a very mild one. I think the market will price it in between now and sometime in October, and then I expect that we'll see things rally toward the end of the year and into 2025. 10-year Treasury yield last week down 20 basis points. So with the big jobs report that came out, we saw a lot of folks jumping into bonds, sending those yields lower. I think that is another really good sign for the market as far as not worrying about inflation. If you're worried about inflation, you have any fears about inflation, you're not going to go, jumping into the bonds. You'll be doing quite the opposite, getting out of bonds. So I think that's that's a positive. But I think there's going to be like this bridge over the next month or two that we're going to have to get over, because I do think if the market is going to sell off, and if it is going to sell off significantly, we're probably in the midst of it right now. The volatility index last week shot back up above 20. Not surprising at all. Remember when I talked about the potential of a bear market, when we saw initial jobless claims going up, unemployment rate was going up, certainly looked like things could be headed in that direction. We saw the VIX explode back at the end of July, early August. I think on August 5th, that Monday, we saw the VIX up at 65. So we had this huge move to the upside in terms of the volatility index. But when we came back down, we went back down below that key 16.5 to 17 level on the VIX, which I have said plenty of times in the past. I'll say it again. We've never seen the start of a bear market see the VIX go soaring, and then during that bear market, see the VIX come back down below 16.5, 17. So the fact that the VIX came back down to 14 and change recently tells me there's not enough fear in this market, in my opinion, to drive us to a bear market for, down 20% or more on our major indices. I think if anything were to get close, it probably would be the NASDAQ, maybe that technology area. But a lot of that is based on perspective. I mean, those are the areas that carried the market to the upside. So we saw outsized gains on the upside. It just makes perfect common sense that when the market struggles, those areas that led are possibly going to see a little bit more downside. And that's what I'm looking for. And that's really what's been happening since semiconductors topped back in, I think it was on June 22nd. So we're not out of the woods as far as possible movement to the downside, but I do not believe this is going to morph into a bear market. That would require the S&P 500 to drop down to about 4,500. I just don't see that. I see probably worst case somewhere in the 4,800s. I believe, though, we'll probably hold on to the 5,000 level, maybe right around there. I think that's going to be a key area for the market as we go forward. Let's see what else. We have crude oil. So crude oil, another sign of economic deterioration. When you see crude oil moving down to a 52-week low, obviously a 2024 low. I'll show you some charts on that just a little bit later in the show, but crude oil prices dropping tend to move with the XLE. So we should be expecting some more weakness in the XLE, which is the energy ETF. And that normally, those two groups normally have very, very strong positive correlation, which again, I'll show you on the charts in just a bit. It was reported recently that the XLU utilities showed the best profit gains from the second quarter of 2024 back to the second quarter of 2023. Utilities profits gained about 21%, whereas the average was about 11%, which is still very strong, by the way. So prior to this weakness that we're seeing now, we did have a pretty strong economy, very resilient, given the huge move up in interest rates over the past few years. So again, maybe we go down a little bit, but I think it's going to be important just to keep perspective in mind here over the next couple of weeks. Just remember the things that are leading the market to the downside. Just remember how much they went up prior to that. I think that'll help get you through these next couple of months. Let's see. We got inflation reports coming up this week. I think they're going to be non-events. Even if inflation goes up, I mean, it might be used as a reason why the market's going down. But I think the Fed has pretty much announced that they have squashed inflation. They're comfortable with it. So I don't think it's going to become as big of a problem. Again, maybe in the short term, if we get something out that's a little negative, maybe that'll impact a day or two. But I really don't think this is going to be a long-term problem at this point. Yeah, and so that's about where we are. So let's take a look at what happened last week. And I'm going to show you that on this chart list of the 6 key indices that I like to follow, the major indices. So we got the Dow Jones, we got the S&P 500, the NASDAQ 100, small cap IWM, mid cap MDY, and then transportation index. Those 6, along with our 11 major sector ETFs. So on this chart, you see there are 17 different areas of the market that are covered. You can see at the top, and this goes back 1 week. So this is the 1 week return on each of these areas. Only 2 were positive last week. So 16 out of the 18 were negative. The 2 that were positive, consumer staples and real estate, 2 defensive groups. Now you might say, well, that's bad. You know, defensive groups are leading. Well, when the market's going down, when you see a down week, almost 5% on the S&P, almost 6% on the NASDAQ 100, 7.5% on technology. When you see that kind of a week, defensive groups almost always lead. That's why they're called defensive. They actually protect you a little bit more during downside action. So what we saw last week doesn't surprise me at all. Now, prior to that, when the market was trying to move up and break out, we saw these groups performing well. And that is a warning sign. I mean, you do want to be careful whenever defensive groups are leading during a move to the upside. That's unusual. But the defensive groups leading to the downside when the market is in a downside or trending lower, that's not a surprise at all. So here you can see on a relative basis, staples, real estate, utilities, healthcare. That's 4 defensive groups, and those are probably, if you told me at the beginning of the week that the S&P would be down almost 5%, and the NASDAQ would be down almost 6%. What do you think the top four groups would be? I would have named those four. So again, no big surprise there. Consumer discretionary, though, after those four discretionary groups outperforming, or discretionary group outperforming the S&P 500 by a full 2 percentage points, or close to two full percentage points. That doesn't sound like a recession to me. It doesn't sound like the market is prepping for a recession. I mean, consumer discretionary showing that kind of outperformance in a big down week, you would think they'd be leading it to the downside. So I'm not going to say bullish, but I mean, that one kind of got the antenna going up, realizing that, hey, maybe this isn't going to be as bad from an economic perspective as some might think. Now, again, this is just 1 week. We'll see what continues to happen. But I do like to pay attention to how the various sectors are performing against one another. I think it helps provide us some clues. Financials finally down, but still outperforming the S&P 500. Same goes for industrials, barely outperforming the S&P 500. But down at the bottom, you can see the groups that really struggled last week. Energy, crude oil prices tumbling. So I'm not surprised to see energy down toward the bottom there. The NASDAQ 100, because many of those growth stocks continue to get hit, especially the semiconductor group. And then technology, because of those same reasons, technology getting hit and moving lower. But again, perspective. Technology soared prior, when we were setting new highs. Coming out of the 2023 correction that we had last summer, and then throughout 2024, we saw a huge move in technology, including semiconductors that went, the Dow Jones US Semiconductor Index went from 9,000 to 21,000 in 7.5 months. And that was mostly in 2024. So it's all about perspective and understanding that when stocks or areas of the market are, just rapidly ascend, they're going to have some pain that they're going to have to go through. That's what we're enduring right now in those particular areas. S&P 500. So again, I want to talk a little bit about perspective. This is a chart that goes back since the beginning of the century. It's a weekly chart. Let me stretch this out just a little bit further. There you go. But almost all the action has been contained within these parallel lines, these parallel trend lines that connect the highs and the lows. So what I did is I connected the low from 2009, the low from 2020. Those were panicked lows. Financial crisis over here, pandemic over here. So when you take that and you take that line and then just drag it up here, you can see it pretty much connects all the tops. But we do have periods where we go slightly outside the channel. And that's where perspective comes in mind. That means that we've gone up too far, too fast. So what happened in 2015 after we were trading slightly outside this range? We had a rough year. Wasn't a bear market, or it wasn't a cyclical bear market or secular bear market, but it was a correction. It was a pretty deep correction. I think we were down probably, 14, 15% or something like that. We hit this top line again back at the beginning of 2018. What happened later that year? We had a trade war. And then, of course, in 2021, when we got to the top at beginning of 2022, that was an easy call that the market was primed for a move back to the downside. Outside the channel, we had negative divergences. The sentiment was off the charts bullish, which we know is a contrarian indicator. So that meant market was very, very likely to drop. Sentiment is what I was really talking about back at Market Vision 2022, back in January of 2022. I said the biggest factor going into trading in 2022 was sentiment. So there were a lot of different big pieces of the puzzle that came together to allow me to talk about the potential of a cyclical bear market before it happened. I'm not seeing all of those same signals coming together now, which is why I keep saying from a long-term perspective, we're fine. Doesn't mean we won't go down 10% from here. But in my opinion, we bounce back and we come back with a vengeance in the fourth quarter and into 2025. But we've got to get past the short-term hurdles that we have right now. And does that mean we're going to lose 10%, move back down to 5,000, maybe even slightly below it? I think that's a real possibility. I also believe that lower interest rates going to help certain areas of the market that I've talked about, small caps, financials, industrials. Those groups still are way up off of their relative lows. So they continue to provide relative strength. And I believe that's going to continue later this year and into next year. So, I think that part of the market is not going to go down much, not nearly as much as technology might. And so I think that those other areas are going to help keep the market somewhat elevated. I mean, if you got the biggest group in the market, technology, going down pretty hard, S&P 500 is probably going to struggle. But again, if you get enough strength in those other areas to hold the market up, fairly well. And when I say fairly well, I'm talking about maybe a drop to 5,000. Look, on this slope of this channel, you can see, look at the middle line that I've drawn, because just about every pullback comes right down near, or it touches this line, or maybe it slightly exceeds it. 2022 with the cyclical bear market went down a little bit more. And I, back at the beginning, that's exactly where I said I thought it was going, was back to test this middle line, just as many of these others had in the past. That's what I was looking for. It's more of a perspective call than anything else. When the market goes up too fast, you've got more of a chance of the market coming back down. And that's, again, look at where this line is. Let's zero in on this thing. I mean, we've rolled over. We started to roll over, but we know from history we could have bigger declines than what we've seen so far. And we've had plenty of tests of this blue dotted line that you see here. Right now, that blue dotted line is sitting at about 4,700 and change, getting close to the price support where we broke out from, which on a daily basis, I think the daily high was around 48.19. So a pullback to 48.20 isn't out of the question. I mean, I think worst case scenario, that's where we go. But I think as we go out a little bit further, you'll see this moves up into the 4,800s by the end of the year. We're up closer to 5,000. So that's why I think, just from a perspective, long-term perspective, it wouldn't be a horrible thing. In fact, I think it would give the market a lot of support for the next surge that I believe is coming. So just keep this in mind. So from a longer-term perspective, even the cyclical bear market that we saw in 2022, we came back up, set new highs. The pandemic that we saw back in 2020, that was scary, massive reversal. The trade war was breaking, we were breaking down, came back up, new highs. I don't think this one's going to be any different. I think if we go back down close to the center line, this blue dotted line, I think we're going to rally back out of it better than ever, and another high coming down the road. If not fourth quarter of 2024, I think first quarter of 2025. That would be what I would be looking at. And the only reason I would think that it might not happen in 2024, it just depends on how steep the decline is and when the bottom forms. If we go straight down and we form a bottom in September and start to roll back up in October, then I think we go back to all-time highs. If it gets closer to the election when we set the final bottom, sometime maybe in October, then I think you only have 2 months. It could happen, but the odds start to dwindle a little bit. Anyhow, interesting chart, I think, and another one to use for perspective. Anytime we go into a bear market or just a fearful period, the VIX over 20, it's time to think about perspective. And so hopefully you can see that. S&P 500 on a monthly chart. I mean, the PPO is coming off the center line, pointing straight up, meaning that any pullback to the 20-week move or 20-month moving average, which we have seen it test a lot in the past, by the way, any kind of a test there sends us down. The 20-month moving average right now is 49.03. Again, right down in that range, 4,800. The August low was 51.19 or something, I think, 51 something, low 5100s. So you've got a lot of different, we go through the weekly, daily, and so forth, but there's a lot of support on the S&P 500 from about 48.20 to maybe around 51.20, that 300-point range. Now, how far we go into that 300-point range, or if we get down there, we're going to all find out together. I'm just saying that the possibility exists. And I would almost say that there's a probability that we're going to go down and at least test that August low. If we go below it, I don't think we're going very far below it. But we know from history that look at 2020, when you go down below a prior low, a lot of times you just get that little kick save and come right back up. If we go back down below the August low, I think it'll be fairly quick, and I think we come right back up above it. So do we break it or not? I don't know. Splitting hairs. XLK versus the S&P 500. Technology, this is what I was talking about. Technology was leading the S&P 500. So this is 32% of the S&P 500, at least it was last time I checked. Maybe it's back down to 30 or 31 now. But it was 32%. When you get 32% of the S&P 500 leading the S&P 500, that means the other 68%, much of that area cannot outperform. You can't have everything outperforming the S&P 500 because all of these groups make up the S&P 500. So when one group goes up, another group has to go down relative to the S&P. And so technology was leading for a while. What happens when it starts to roll over? Well, does the money completely leave the market? Does everything go down on an absolute basis? I mean, you can see technology rolling over, but are other areas of the market going down? Because that would indicate money's leaving the market. But if technology is going down and other areas are actually breaking out to new highs, then in my opinion, there's not a whole lot of money that's leaving the market. And I think that's what is happening now. I think we're getting rotation. I mean, we'll see. That's my call. Relative strength on an industry basis over the course of last week. Look at the groups. So in every industry group, I number all of the consumer staples, by the way, would be number 7. That's the 7th group in my list. Real estate is 8. Communication services is 3. And then individual industry groups I have numbered from 1 to however many industry groups there are within that particular sector. And one way to do this is just to show you here. Here's, if I order it by name, here are all technologies, 001. And then I've got the industry groups numbered 1 to 8. I do that for all 11 sectors. So when you're looking at the percentage change here, I do it so that when I pull this up, I can quickly look and see the sector. And look at the XLPs, how many XLPs we have in the top 10, because that's consumer staples leading last week. So we had brewers, we had food products, we had distillers and vintners. Here's another one. This was non-durable household products. Tobacco, go down a little bit further. There's soft drinks. Clearly, staples did really well last week, and we already saw that. I showed you they were the top performing industry group. Communication services had the top performing industry group last week, but it was fixed line communications. If you know anything about this group, that's a pretty defensive area within communication services. Then you've got real estate. So you got your diversified REITs. Industrials, you got airlines, you got transports. Some of the areas of transports did fairly well last week. Real estate, there's your specialized REITs. Financials, you got insurance brokers. In other words, where's the XLK? Where is the XLK in all this? Where's technology? Where is computer hardware? Where is semiconductor? Well, if you flip the chart, you'll see semiconductors as the worst performing group last week. And now you'll see a lot more technology. Remember energy? I said crude oil broke down. So a lot of the energy stocks were down last week. So you got energy, materials. There's a discretionary area, more materials, industrials, materials, technology, energy, technology. Starting to see that theme. So crude oil prices taking energy stocks down. We have fears about growth taking technology down, that whole area, and many of the individual industry groups within that area, including semiconductors, the worst performer last week. So it was, again, a case of folks just ditching all those high octane growth companies and looking for more safety, more dividends, and that sort of thing. And when the market's selling off and it's in September, this is normal. I mean, this is not anything unusual. It's kind of like, a hurricane hitting, the Gulf Coast or something in September or October, or coming up the eastern seaboard. I mean, this is the time of the year for that. Same thing for stocks. This is the time of the year. We know historically, September, not a good month. So, again, we should be much more cautious. I said back in July, lower your bar of expectations over the next few months. We're not trading, very unlikely to trade the way we had been trading leading up to that. And we're seeing that now. Technology on a monthly basis, you can see the chart pulling back. I mean, does this look horrible to you? Again, this is perspective. This is coming out looking at a monthly chart. I mean, as bad as the cyclical bear market was, look how far we had gotten above the 20 and the 50-month moving averages. So we came down, we tested the 50-month moving average. We did that back in 2015. We got close during the trade war in late 2018. We got close during the pandemic. Well, we actually made it during the cyclical bear market to that 50-month moving average. And then we simply started taking back off again. And then what I'm looking at right now on this chart just looks like, I mean, if you owned a stock and you were looking at this stock on a daily basis and you looked at this and each one of these candles was a daily, you'd be looking at this saying, hey, this is a pretty nice looking chart. Maybe if I can get a 20 period test, I'll jump in. Why would you think about the market any different? XLK looks pretty good. It's pulling back. It's been a leader, but now it's pulling back. What's wrong with the 20-day test? I mean, maybe we go to the 50. I don't think so. I think it's going to be somewhere probably in the 180 to 190 range. We broke out from 180. That's a little bit below the 20-month moving average, which is at 189 or roughly 190. So we're sitting at 203. Remember, we were just up at 240. So we're down $36 on the XLK. And I'm sitting here saying, worst case I see is maybe we lose another 24 from 204 to 180. That's kind of like the worst case, which is only 2/3 of what we already have dropped. Another 24 points versus the 36 we've already dropped. So in my opinion, the worst of the selling is behind us, but it doesn't mean we're not going to go a little bit lower. But this is, now is when everybody's starting to panic and starting to think, oh, this is horrible. It's actually the time that if you got out in July and just sat in cash, you probably would start thinking about, hey, I'm going to start dipping my toes in the water. And if we keep going lower over the next month, 6 weeks, I'll just keep adding, getting back in at cheaper prices. Steel's had a rough period. You can see since topping back earlier in 2024, we've had a really steep drop. This area is already in a bear market. I mean, we were well up over the 700 level. Now we're down close to 500. I mean, we're down over 30% or maybe close to 30%, something like that right now. So steel's in a bear market. Steel's also an industrial metal. I mean, that's used in construction around the globe. And so seeing crude oil prices coming down, which reflects maybe weak global demand, seeing steel prices coming down, weak global demand. By the way, how's inflation with all of these different signs of weak global demand? Tell me how inflation surges again, because I don't get it. I don't see that at all. Some are still talking about inflation is going to be a problem. I don't see that. Semiconductors. So here's a daily chart on the semiconductors rolling over, getting closer to these bottoms that we saw in April, which was down around the 13.6 level, and then maybe 14.6 on August 5th. We finished last week at 15.8. I would not at all be surprised to see these two levels come into play. And because this is the most volatile area, very aggressive, if the market does have its struggles, I believe this is the group that's going to scare a lot of folks. I did a video for stock charts last week, and I said, basically the question I was asking was, is it possible NVIDIA goes to $50? Remember, its high was over 140. And of course, some of the responses are no way. I mean, I probably think that too, but I'm just saying that it's a possibility. If the market, when stocks sell off and you get fear, we don't start losing money on stocks like NVIDIA by the pennies or the dimes or the quarters. We start losing it by the dollars and the chunks of dollars. We've already seen that on NVIDIA from 140 down to 103. I'm not sure exactly where we closed on Friday, but maybe around 103. If we break these lows on semiconductors, I would not be at all shocked to see some NVIDIA approach $75 level. And I threw 50 out there. I think that's definitely a stretch, but I don't think it's out of the question. I would say the odds of it probably aren't very great, but I do think it's a possibility. Remember, I think it was NVIDIA started the year in 2024 at $50. If we end the year at $75 or some point during the next 3 months, 4 months, we go down to $75. Perspective, think perspective. We're still up 50% on the year, even at $75. But people don't think that way. People think, oh, when NVIDIA gets to 140, it needs to go to 150 and then to 160 and then to 200 and 300 and 500 and 1,000 and I'm going to be rich. And that's not the way the stock market works. You get a lot of greed. You get a lot of folks pouring in at the top. We had that reversing candle that I talked about right here on June 22nd. Wrote an article that day that was a top. I mean, I'm not surprised at all what's happening. Again, perspective, 9,000 to 21,000 in 7.5 months. I mean, a 50% retracement from 9,000 to 21,000 is 15,000. We did that at the August low. I think we could get the 61.8% retracement on Fibonacci, which would take us probably about another, I don't know, 2,500 points lower than where we are right now, which could take us down to threaten, maybe even slightly move below that April low. That would scare everybody. And sometimes that's what you need to mark the bottom. Volatility index, talked about this earlier, had a huge spike beginning of August, came back down. This is where we went back down into the 14s. If the S&P ultimately loses 20% now on this move to the downside, it will be the first time in history, at least since the VIX was created, it will be the first time that during the bear market, the start of the bear market, when the VIX shoots through 20, it'll be the first time the VIX comes back down below 16.5, and we still end up going and having a bear market. So the fact the VIX is back up, I'm not shocked. What I would be shocked about is if the S&P 500 actually lost 20%. Maybe it will. I don't think it's going to. I don't think we're going to get close to that. But we could go below 5,000, which would scare a lot of folks. Even moving below that August low, I think would scare a lot of folks. But the fact that we're still in this high volatility environment tells me you've got to be cautious. You have to be cautious, because when the VIX is above 20, that's when the biggest impulsive moves in the market to the downside occur. So, I mean, if you want to just sit there and hold like you're in the middle of an uptrend in the market, that's fine, but we have totally different market conditions. If you're a long-term buy and holder, by all means, hang on. That's what I would do. If you're somebody that doesn't really watch the market, you're much more concerned about where the market is in 3 years versus where it is in 3 weeks, then sit tight if you don't want to get involved. A lot of people simply just don't want to trade. They don't want to try and time the market. I get it. Some people just want to, it's going down. It's an opportunity. That's the way you should look at it. Maybe add some more. Your 401k, any contributions going in. Now we're going in at lower prices, so that when the market bounces back, you have even more of a pop back to the upside in your retirement account or your taxable portfolio, whatever. That's long-term. Those are folks with a long-term mentality. The problem is some people say they have a long-term mentality and the market breaks down, they panic. Well, if you truly have a long-term mentality, I believe the market comes back. That's my opinion, of course. I don't have a guarantee. I can't provide you a guarantee, but based on what I've seen, all of my studies, I'll be very surprised if we're not back at an all-time high later this year or early next. And that could come with another 5-10% drop from where we are now. Last thing I want to talk about is the crude oil prices and the XLE. So here's crude oil prices. You can see back in the end of September last year, we were up $94 a barrel. In April, before we had that little pullback in the market, crude oil got up to almost $88 a barrel. The recent high in July, we got up to $84 a barrel. Less than a month ago, we were at $80 a barrel. Well, now we're down below $68 a barrel. And I don't know where you all live in the US, but I can tell you our gas prices down here are the lowest we've seen in a long time. And that's one thing where I am in South Carolina. Our crude oil prices are, I just got gas yesterday, $2.71. Now, I know for those of you listening on the West Coast or maybe up in Canada, probably are like, what? Because I know your prices are a lot higher, but you're probably still, even though they might be a lot higher than what we have here, they probably come down quite a bit from your high. So I don't know whether crude oil prices goes much lower than this or not. But I got one more chart here. This is a little bit longer term. This is weekly going back 15 years. Top part is crude oil prices. The bottom right here is the XLE. And it almost looks like an identical chart. I mean, if you just kind of look at it here, we went up a little bit more on the XLE than we did on the WTIC, and then we fell apart there. And of course, then the XLE came back down. But for the most part, when you're looking at this, we see similar things happening. Now, back in 2022, this is the bottom panel here is correlation. So this is telling you that the WTIC, which is the crude oil prices, relative to the XLE, are they moving in the same direction or not? And when this correlation coefficient is near 1, it's telling you they're moving hand in hand together. If you go down to -1, it means one's going up, one's going down. It's complete opposite or inverse correlation. And then anything in between is just somewhere in the middle in terms of how closely they're following one another. You can see over the last 15 years that we reside mostly above 0.5, and many times we're at 1. So the two are very, very positively correlated, which is what you would expect. But there are times when we see negative correlation. And right now we're kind of at a low reading because look at what's been going on. We've seen the XLE going up while crude oil prices are going down. And the fact that crude oil just dropped to $68 a barrel, which is the lowest we've seen since back in, well, probably 15 to 18 months ago. And the energy's lows keep going higher. There's been a little bit of a disconnect here. So which is going to happen? Are we going to see crude oil prices jump back to the upside, or are we going to see energy tumble here, XLE? I think we might see both. I could see, I mean, we're right on a trend line right now on the XLE. We break much below that 85 level. I could easily see us down 75, 80. So, I mean, maybe that's not a crash, or maybe it's not even a tumble, but it's, pretty decent drop. I mean, I could see energy going back to 75, 80, but once the interest rate cuts begin to take effect and the market start, they don't even have to take effect. It's not like we need to see them showing up in economic reports over the next couple months, but the stock market will begin to anticipate the strength. And so if you wait to see good reports, the market's already going to be up a lot because it anticipates. Just like 2022, we had the cyclical bear market, and the first interest rate cut, I believe, was maybe in March. And I think it was maybe like a quarter point or something. I think the first 50 basis point hike was in May. By the time May 2022 rolled around, the S&P 500 was already down near its low. The majority of the losses had already been inflicted. The pain was already there. And then the rate cuts started, or rate hikes started. And so I think what you're going to see is the market weakening, maybe the economy weakening, and the rate cuts are going to get started. But by the time we get into the first, maybe second rate cut, I think the market's going to be ready to go to the upside. I think we're going to be at a bottom. So first rate cut is coming up next week or a week and a half. So we've got, I think it's the Tuesday, Wednesday, 17th, 18th, maybe. I think it's 17th, 18th. Where the Fed's likely to cut, will it be 25 basis points, 50? I don't know, but they're probably going to cut. Anyhow, that's it was kind of a crazy week last week. There was a lot to go over. I know this is running on a little bit longer than usual, but I really wanted to make sure I could get through and cover a lot of these different topics that I wanted to cover. It's September. That's all I really can say. You've got to be prepared for movement to the downside. But also, I mean, in my opinion, I wouldn't be afraid to be using weakness to begin building long positions. If you did move to cash, maybe back in July, when the historical period began to turn from bullish to bearish, Now would be the time I would be using these types of big drops to hold my nose and start building positions. And I would just do it over time. I wouldn't do it all at once. But I think now, between now and sometime in October, I expect we're probably going to see a bottom. And so use weakness. If you have cash and you've been sitting and waiting, I would use the weakness to get in. If you're already in, if you're a long-term investor, like I said, I have no problems holding through this. You might, again, have to suffer through the next 5, 10, maybe 12%. I don't know how low we're going to go. And we could always go more than I think. I just don't believe it's going to be that deep. I think it'll be fairly quick. I think it'll be somewhat painful, just like last week was. But I do think that we will see a reversal in the fourth quarter. Anyhow, everybody have a great rest of your weekend, and I'll be back next week to do it all over again. Enjoy the week ahead. Happy trading.